With the changing face of the global economy, investor behavior has once more come into the spotlight. To talk to us about investor behavior and how bad decisions could result in a client doing worse than the market or the fund that they are invested in, we're joined in studio by Shaun Latter, Managing Director at Quaestor Wealth. Thank you very much for your time.
Thank you.
Firstly, we've just finished chatting to Roger Williams from Centaur Asset Management. He doesn't think that we could go back to the 2008-2009 levels of financial crisis. Do you feel that we will?
I think let me come straight to the question of how do I feel, because that's the essence of what we're going to talk about. And I think before we can start intellectualizing about how to invest or where to invest and what stocks are good and not, we have to acknowledge that at our core we are emotional beings as humans, and we can take it from there. So do I feel we'll get to that point? Could possibly happen, but none of us know. I think that's the certainty that
Are you still sleeping well at night?
I'm certainly sleeping very well at night, and I like to think my clients are sleeping very, very well. I think what it comes down to is, as an investor, and if we take the words of Warren Buffett, he says investing is simple, but it's not easy. Okay, so what we do is simple. But the not easy part, I believe, is from an emotional perspective. And everybody goes through those moments of despondency and euphoria and fear and greed and everything in between. What's important is how we then take those feelings and respond to the market or to the investment portfolio that you have running.
You would think that somebody sitting there now looks at what's unfolding on the global front and says, well, yes, Greek exit from the Eurozone could be priced into the market, but we could see this pushing us into another global crisis because of the contagion from the banking side, etc., panic, risk off trade, sell-off in all emerging markets, etc. You could see somebody, a South African investor there sitting thinking, I don't want to go back to 2008, 2009. Let me take my money right now. I don't know where you put it, but perhaps you put it under your mattress, wait for the turmoil to unfold, or wait for yourself to see yourself clear through this period and then say, all right, let's put the money back in again. Isn't that quite simple?
Absolutely. I mean, I think you see a lot of people doing that. And if we had a look at, there's a number of statistics to show that when the market's running, only after it starts running, people start entering the market. And when it drops, they get out of the market. And so you have this total inverse relationship between what the market's doing and who's then going into fixed deposit and money market. So if we take it back to from a behavioral finance point of view, there's something called prospect theory or also myopic loss aversion. And what we have as humans is an inherent fear that our experience or pain of loss is twice as drastic as our joy of gain. So when we look at a market and we kind of go, 50-50, we're saying, well, if I'm a 50% wrong, I'm going to feel it twice as bad on the downside versus what I'll feel on the upside.
Hence, I'd rather sit with my money under my mattress.
Exactly, and that's where we get a lot of people then exiting the market. And by and large, they become more conservative investors over time.
So Shaun, if you were investing for a client now who came to you with a lump sum, at this stage with the market at 33,300 or so from 18,003 and a bit years ago, how would you express yourself to this client? If he's going into, say, a riskier fund, an equity-oriented fund.
Yeah, it is a difficult one. I mean, if we look at the basis of how we normally go about advising, what it comes down to is about saying, what are your expectations, what are your objectives out of this money, and are you prepared to take on the possible risks of that? If yes, great. If no,
do you ever ask them, are you
reevaluate.
prepared to see a 50% fall in your investment and still sit strong?
Absolutely. Depending on what the investment objective is, it really is around saying this is what could happen. And we've got the last 110 years of history to say in any given year, as an example, if we've got a predominantly equity portfolio, you could drop by 40% in a single year. Are you okay with that? And really it is around also educating and pre-warning clients on asset class behavior. And so one of the things that we look at is to say, by and large, the equity market goes up 2 out of 3 years and down 1 out of 3 years. But are you going to be okay with that?
I mean, the reality is, Shaun, we are emotional beings, and absolutely, education is the key, and somebody can very easily say, yes, I can stand through the volatility, but when it actually happens, when 50% of your wealth is wiped out, you can't sleep well, surely. I mean, that's just what we are.
Absolutely. Absolutely. And again, that comes down to what I'm seeing more and more is the role of a financial planner is around sitting down and coaching and guiding those people through the decisions.
You have to
that
be
are
a
available.
psychologist.
By and large, yes. but certainly it's around, once we set an investment framework for somebody, that is something we'll always go back to and say, right, this was the discussion that we had. This is the framework that we had. These were the expectations that we have. Has anything changed from those expectations? Okay, so take it less drastically. If we do have a middle-of-the-road investor, it's around saying, okay, so it has gone down 10, 15%. But was that totally unexpected? Yes or no? By and large, we're finding a range bound with what history's taught us.
And how are you finding the prevailing sentiment at the moment amongst your clients in terms of fear, optimism?
Let me take it back to another behavioral finance, which is regret theory. Now, regret theory is really around saying, I've got a decision to make, but I'm too scared to make that decision. So I'll just stay where I am. Therefore, I don't have to fear being wrong. Never mind the fact that staying where you are, not making a decision, is a decision in yourself. So what I see a lot of is a lot of people are very scared, very fearful, and very anxious about their investment portfolio and, in turn, their future financial wellness. What it comes down to is when we start making changes and advising on how to better that portfolio, some people are sitting back and going, I'm too scared to make a decision about this. I'll just sit it out. And if I do nothing and it goes wrong, well, I've done nothing. So that's a very, very difficult barrier to cross in terms of getting people to act on something that is in their best interest, despite what
Perhaps
they feel.
coming back to Paul's question, where are we in terms of the fear barometer among your clients? Is there more fear out there at the moment, or are you perhaps...
Than a year ago, 2 years ago, 3 years ago?
No, definitely not from a year ago. By and large, a lot of people are actually feeling a lot more content, and perhaps there's a danger in that. So they've kind of seen the market. Again, when we look at it, we backward look at pattern-seeking people, and we only tend to look in about 12-month periods. So one looks back at the last 12 months and kind of goes, it's okay. So there's a contentment, certainly, around there. Is it risky? Yeah, sure, absolutely. And there's dangers in feeling content, perhaps right now, if you don't know that your portfolio is correctly structured for your long-term objectives.
Paul, any more words of wisdom from you before we close out on the show this evening?
How optimistic are you?
How optimistic am I?
Yes.
Paul's got no words of wisdom. He wants to know what words of wisdom you have.
To me. Look, I think, to cop out, it's very, very difficult times. And I think one has to look at their portfolio very, very carefully and see whether you are positioned correctly to capture whatever upside in whatever asset classes and whatever geographic regions you are, most predictably and with as much certainty as possible. That's all you can do. So right now, I don't think there should be any big bets taking place, and diversification is obviously going to be the key.
Well, let's leave it there. Diversification, the key when there's great uncertainty in the environment. Shaun Latter, Managing Director at Quaestor Wealth.